Hey, good morning, everyone. Marty Mazzora here, August 12th, 2025, with a try to keep it brief update for you. This morning, I'll just talk about the CPI data that came out briefly, and I do want to talk about market breadth, which is just kind of yelling at me through my screen here of late, or continues to, I should say. So, with regard to CPI, I'm just going to paraphrase from Peter Bookfar's commentary this morning. So July CPI rose 0.2% headline and 0.3% core, which X's out food and energy, with year-over-year gains of 2.7 and 3.1% respectively, versus a 2.7 and 2.9% the month before. Energy fell 1.1% due to a 2.2% drop in gasoline, which really, they didn't fall. It was what's called a seasonal adjustment that brought that down. And they're down 1.6% year over year. Food prices were unchanged, up 2.9%. Services inflation, not including energy, were up 4.4% and 3.6% respectively. And then he gets into all of the minutiae. Furniture and bedding was up 0.9% in July. Appliances were down 0.9%. Other household stuff like clocks and furnishings were down 0.2% after rising 1.7% in June, and so on. Bottom line, both treasuries and S&P futures definitely are breathing a sigh of relief. The S&P is up 0.75% as I speak. Clients, most of our core positions are up. Gold's down 14 basis points. That's 0.14%. Utility stocks are actually down 0.4%. It's interesting because bonds are no longer expressing a sigh of relief. Interest rates are now up, and the long-term Treasury ETF is down 2/3 of a point. Overall, our core allocation is up 0.53%. So having a nice day. Not quite what the U.S. market is doing overall, but close enough. Yesterday, the market was down a little bit, and we were just down 10 basis points. So again, our portfolio, as I keep saying, we have very definite concerns about the level of U.S. stock prices, which I'm going to express once again here this morning. But we've had a really good year so far in our core allocation, thanks to positions in, precious metals, non-U.S. equities, and just other places, a couple of individual positions as well, and a good chunk in U.S. equities, which have come back nicely since the April bottom. But it's really more of a global macro multi-asset portfolio, so it's not always going to correlate with the U.S. market. So again, no complaints here at PWA, but definitely some concerns that we're continuing to hedge against, if you will. Again, from Bookvar, Treasuries and S&P futures are breathing a sigh of relief, but Treasuries no longer, at least on the long end of the curve. And that's because the CPI came in at or maybe a little better than expectations. It didn't blow anything out of the water, which really wasn't expected, but I guess the market just needed to see it. Michelle Bowman, who was a dissenter at the last meeting, has jumped out there and said they need 3 rate cuts this year. And man, she went there very quickly. That's not the consensus, I don't think, among the members. In fact, I'm certain it's not. I think they're still concerned about inflationary pressures. They're nowhere near their 2% inflation target. And the impact of tariffs, I think a lot of that is still yet to come. Remember that companies and consumers, by and large, loaded up on what they could ahead of the tariffs. So we've had quite the inventory build that's flowing through the market now. Having said that, I do know the government has collected billions and billions of tariff revenue so far this year already. So, nevertheless, that inventory has been somewhat of a headwind for higher prices, and that obviously isn't going to last that much longer. Then there's my argument, and not just my argument, there is the argument that tariffs ultimately are a tax, and taxes are ultimately disinflationary. So to the extent that people are having to pay up for some items, that means there's less money to be spent on other items. Therefore, the price of those other items should wane. That's the disinflationary impact, potentially, of tariffs. It's ultimately probably a hit to the economy. Now, also reading through highlights from lots and lots of earnings statements, the earnings are continuing to come in decently, and the outlooks really aren't that bad from my observation. So even though we have underlying concerns about the economy, even though the jobs number last month that shocked the markets did not surprise us based on the underlying data, it's not horrible. It's not terrible. It doesn't all say recession is imminent. We think the odds are still way too high for comfort over the next 6+ months. And maybe that's where Michelle Bowman is coming from. Maybe she's believing that and seeing the same thing. The data that's coming out, like the inflation data and other indicators on the ground, aren't signaling massive recession risk right here. So, the Fed at large, their statement is that they are going to continue to assess the data as it comes in. Market expectations of a Fed rate cut in September are 96%. So that's locked at this point. The Fed will not buck a 96% futures market discounting of a Fed rate cut. So we should expect that unless the August data come in hot, because there's no meeting in August. By the end of the year, 2 rate cuts are priced in, 3 are priced in by January of next year. Okay, so enough of that. Let's take a look at the charts. So here we are having a nice day. That clear candle up there, the white, is an up candle, and you can see the market right now is trading near the high of the day, and it's touching on, or about to touch on, the all-time highs. However, the momentum is, rolling over. You can see. So we've got these bearish divergences that are not going to get burned off right here. And then when we go back historically, as we have over and over again, we ultimately, more often than not, unless these bearish divergences are corrected, we get really significant momentum, which we very well could, by the way, if we break through here with some force. But without that, typically you can count on the market rolling over. The longer term charts look worse, frankly, or every bit as bad, I should say. To introduce kind of the breadth readings today, I wanted to talk about the S&P 500 equal weight. So the one we typically look at is what's called the cap-weighted index, and that means that the largest companies have more influence on the index than the smaller companies. But if we take all 503 stocks, however many there are in the S&P 500, and just give them equal weighting, how does that look? If you just bought, 1/500th of each, if you will, how would you do, right? So it gives you a better, broader look at the market. And as you can see here, we have what would be kind of a classic double top pattern. We came back, hit that last November high, and then failed right off of that. Okay, so that is not a good look. And frankly, it made sense given the divergences in this particular index. And now, we have it coming down. And, you could argue right now that this looks like a lot like a bear flag pattern. You've seen many of these that I've illustrated for you over the years. If that were to play out, then the market breaks here and you get a move about the length of the flagpole, which would take you below what should be support area right there. And then we'll be talking about other levels. Technically speaking, this does not look unlikely. Let me put it that way. But it speaks to, more than that, it speaks to the overall health or lack thereof of the rally. All boats are not rising with the current tide, as much so, if not more so, than we've ever seen historically, frankly. The NASDAQ 100 index is inching its way past the recent all-time high, and doing so amid very notable bearish divergences. So just need to be aware of that. These are the long-term bearish divergences that concern me, only because we've been doing technical analysis like this for many, many years. And so, folks, this is the voice of experience, not just the voice of someone who, has studied technical analysis. Okay, the breadth. So the S&P 500, simple line chart, and the number of companies that are trading above, number of members in the S&P trading above their 200-day moving average. This is quite the gap here between the S&P and its 200-day moving average, and just a little more than half are actually above that. Now notice when we've had these patterns of late, here we were before this 20% correction. The market was melting higher, but not everybody. So the market really wasn't. It was mostly a handful, and you know the names, those big tech stocks, right? And then really rolled over hard before this peak right here. And you can see a similar thing here. Here we are rolling over in terms of breadth at new all-time highs. You can see it here before the 27% dip right here. Here we are, moving nicely up into all-time highs, and then terrible breadth on a relative basis, and you can see what happened. And then before the 2020, 35% decline, even though COVID was a big surprise, breadth was rolling over, on its way in to that big correction. And folks, I could take you back 50 years and you're going to see the same kind of patterns. And they work in both directions. So here we had a lower low, but we had a bullish divergence, or nearly a bullish divergence on this particular indicator. And we definitely had one as the market was petering out down here. Here we had the market going up, and to this point, this confirmed the rally and said that it had more steam. It's only before this 20% correction, and definitely where we are right now, that says be careful. Shorter term 50-day moving average, you can see essentially the same pattern, maybe worse. 54% or above the 50-day moving average when we have a nice gap here already in the index. Same sort of patterns, folks. A little more to look at because it's shorter term, but these divergences are just there. You can see right here in the 2023 correction that we had, you can see that we had a line right here showing that the market was down, but breadth was getting better. That was a sign that we could see a sustainable rally for a while. This isn't that sign that we're getting right here. And again, we got it right there at the 2022 bottom. We got it a bit right here at the 2020 bottom, and all these corrections as well. This is not that. This is what we tend to see when the market is ripe to roll over. And then just looking at the NASDAQ very simply, the NASDAQ 100, which has just come absolutely roaring back, right? Well, the NASDAQ equal weight came back and then failed to keep that all-time high. Right now, as we speak, it's threatening it. So again, this is the NASDAQ 100 components, all equal weighted. This is the cap weighted, which is just incredibly concentrated in those top names. The scariest breadth chart to me on planet Earth is the NASDAQ Composite Advanced Decline Line. This is really, really not a good looking chart. As you can see, the last time we had divergences this bad were right before 78% hits and 56% hits respectively. Folks, I'm not suggesting, nor predicting, nor anticipating certainly a 78% hit or a 55% hit even for the NASDAQ Composite Index, although anything's possible. And when it's happened in the past, it's when we've had this massively concentrated market like we have right here. Okay, so what else do I have here? Oh, I also pulled up my S&P 500 versus the small cap Russell 2000 index and versus the transportation index. So typically you want confirmation from these very economically sensitive indices, like small caps and like transportation stocks. So you see, well into all-time high territory for the S&P. The Russell 2000 American companies, smaller companies, are not even back to their 2021 highs. So these stocks are actually down over the last 4 years, as you can see, and very bearish divergence relative to the S&P 500 currently. Same things for transportation stocks, right? So again, all the way back to early 2021, they still have not come back. They're still down from that point there. So again, folks, just another illustration of how really poor the breadth is, and historically, how these patterns have led to something not so good for the S&P 500, right? 35%, 60%, 50% respectively declines. And then valuations, price to earnings ratio, earnings can be manipulated, and then all the share buybacks as well. And here we still sit very much in our shaded danger zone as the market tries to force its way to new all-time highs. Price to revenue or price to sales, much harder to manipulate. And as you can see, it's virtually at all-time highs, which is right back here. And I mean all-time highs. And you can see that historically, and I can run this back an eternity. And you just don't see new bull markets starting from these valuations. Maybe this will be a first, and we need to be open to that possibility. But we cannot, as conscientious money managers, not pay attention to this, recognizing that valuations are terrible timing tools. Market can stay up here for a very long time. And then price to book value at all-time highs, right? So, just not a place to get cute or get crazy here if you're a long-term investor. And then Warren Buffett's indicator, as they say, the Buffett indicator, it's the total stock market cap relative to the economy, to GDP. It sits at all-time highs. Here's a chart that takes you back to 1972. Here's before the tech bubble burst. Here's before the real estate bubble burst. And here's before that 27% correction in 2022. So got to pay attention to that. And then Robert Shiller, Nobel Prize winning economist, the Shiller-Cape ratio. This is a favorite of many of the best analysts and portfolio managers in the world, and you can see that it's sitting right up here. The all-time high was right before the tech bubble burst, and you can see where it sat right before the 1929 crash. This goes back to the 1800s, and you can see it right before the very ugly 73 and 74 bear markets, and again right before the tech bubble, and right before the decline in 2022. So, folks, again, I am not complaining by any stretch of the imagination, but we cannot see what we're seeing. I've shown you breadth, I've shown you valuations, and our own economic indicator is flashing a red sign, not desperate, not end of the world stuff. If we do see a recession, we don't think it's going to be a doozy. We think it's going to be relatively mild. But we're just not seeing a lot of things from a long-term fundamental as well as technical perspective that makes us feel warm and fuzzy right here. It makes us think that we need to stay very diversified across asset classes, make money where we can, and hedge against the potential for something significant to the downside off of these historic levels. Thank you, as always, for watching and listening. I'll be back at the end of the week or over the weekend. Take care. Bye-bye.